Goldman Sachs surged nearly 5% on Wednesday, not because of its own earnings, but because it landed the lead underwriter role on a deal that lost $4.2 billion in 3 months. SpaceX filed IPO paperwork with the SEC on Wednesday, targeting a raise of roughly $80 billion, which would make it the largest initial public offering in history by a wide margin. The previous record was Saudi Aramco's $29 billion offering in 2019. That comparison is the session's real signal lives. All 3 major U.S. indexes climbed. The Nasdaq Composite led with a 1.1% gain. The S&P 500 added 0.76%, and the Dow Industrial Average rose 0.96%, boosted in no small part by GS's weighting as its heaviest stock. The catalyst was dual. Crude oil fell below $100 per barrel after President Trump described Iran nuclear negotiations as being in their final stages, and SpaceX's filing detonated a wave of IPO optimism that lifted sentiment across the tape. Nvidia gained roughly 2% heading into its Q1 earnings after the close, adding approximately $100 billion in market capitalization in a single session. AMD jumped 7.4% after failed labor negotiations at Samsung raised memory supply concerns. The session wore the appearance of a clean risk-on day. Under that surface, the SpaceX document told a different story. The filing disclosed that 2 of SpaceX's 3 business lines lost money in the first quarter. The rocket launch unit posted a loss of $662 million. The XAI artificial intelligence unit, absorbed from Elon Musk last year, lost nearly $2.5 billion. Only Starlink, the satellite internet service, turned a profit, $1.1 billion. Net across the company, SpaceX lost $4.2 billion between January and March. That is the financial baseline on which a $2 trillion valuation is being constructed. A $2 trillion valuation for a company generating $1.1 billion in quarterly profit from its only profitable segment implies a price-to-run-rate earnings multiple that no conventional discounted cash flow framework can close. Tim Farrell, president of TMF Associates and a satellite industry analyst, stated plainly that even Starlink at full capacity cannot justify the number. His precise framing: the valuation is completely dependent on the degree to which people believe in Elon Musk. It's not dependent on the current business. That admission is what the market absorbed on Wednesday while bidding GS higher. The IPO is not a bet on cash flows. It is a bet on a single person's ability to continue expanding the total addressable market faster than the losses accumulate. The XAI unit lost $2.5 billion in 3 months. The rocket launch unit lost $662 million. Both are being priced as embedded options on long-duration payoffs: Mars colonization for rockets, artificial general intelligence for XAI. Options pricing depends on time horizon and volatility assumptions, not current earnings, which means the valuation framework for SpaceX is structurally different from any comparably sized public company. Here is what that difference forces on public market investors. The post-IPO record for high-profile, high-valuation listings has been poor by historical standards. Franco Granda, a PitchBook analyst covering SpaceX, noted that for closely watched companies whose valuations soared under private ownership, going public places the number under much heavier scrutiny, and that the big valuation is sometimes hard to justify. Historically, post-IPO stocks underperform the broader market. Granda's phrase was, "pretty jarring how bad it is." SpaceX enters that historical pattern from a valuation peak that dwarfs prior examples. The more immediate risk is the Musk concentration factor. SpaceX holds billions in Department of Defense and NASA contracts. According to Bricetech, 85% of all global launches in 2025 were aboard SpaceX rockets, ahead of nation-states. That dominance is real, but it flows through a single founder who simultaneously controls Tesla, XAI, and has recently stepped back from an advisory role to the White House. Any reputational or political shift affecting Musk directly reprices the equity without touching the underlying business operations. That is a risk type that conventional sector analysis does not price.
The unresolved question from the filing is not whether SpaceX can grow. It is whether the public market can absorb a $2 trillion valuation on a loss-generating company at the same moment the Fed's own minutes warn of potential rate hikes and the 30-year Treasury has crossed 5%. High-duration assets and a pre-profit company priced on long-horizon optionality is the highest duration asset that exists, compress when discount rates rise. The 10-year Treasury note has pushed to approximately 4.6%, a one-year high, according to current market data. Fed minutes from the April 28, 2029 meeting, released Wednesday, showed that a majority of officials warned a rate increase would likely become appropriate if inflation continued running persistently above 2%. That session produced 4 dissents, the highest number since 1992. The minutes explicitly stated that many participants indicated they would have preferred removing the language from the post-meeting statement that suggested an easing bias. New Fed Chair Kevin Warsh inherits a consumer price index at 3.8%, the hottest reading since May 2023, and a wholesale price index running at 6% annually. A rate hike environment is precisely the backdrop under which the $2 trillion ask becomes hardest to defend. The SpaceX filing is timed into a liquidity window that may be narrowing. The broader IPO pipeline amplifies that pressure. OpenAI is reportedly preparing to file confidential IPO paperwork within days or weeks, targeting a public debut as soon as September, according to the Wall Street Journal. Goldman Sachs and Morgan Stanley are the lead banks. Anthropic has been cited in the same wave. These three offerings, SpaceX, OpenAI, Anthropic, would collectively place more loss-generating artificial intelligence infrastructure on public balance sheets than any prior tech cycle. The historical parallel is not the dot-com IPO wave of 1999-2000, though the surface resembles it. The better comparison is the 2021 SPAC boom, in which high-duration, high-loss companies were absorbed into public markets during a period of near-zero discount rates. That window closed when the Fed began hiking in March 2022 and did not reopen. The SpaceX filing arrives when the Fed's rate path is once again contested, not settled. If Warsh signals at the June 16-17 FOMC meeting that the easing bias is formally removed, the condition the April minutes already flagged, then the duration math on a $2 trillion loss-generating company changes materially before the offering price is even set. The $80 billion raise is the verification number to watch. Whether the final amount holds or gets revised downward in the weeks before pricing is a direct signal of how much conviction institutional buyers actually carry versus what they signal to Goldman in the room. If the raise is trimmed, the $2 trillion handle almost certainly does not survive contact with a public order book. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.